Good morning, afternoon, or evening to everyone attending this webinar today. My name is Matthew Borto. I am a portfolio manager on the emerging markets team at Fiera Capital, and I'm here with Dominic Boker-Ingram, senior portfolio manager for the emerging market team, also at Fiera Capital. And today we will be talking about Trump, trades, and tariffs. It's very important for us to be clear that we are looking at this in the context of understanding how to make money in this environment, regardless of the situation in the US. We will not be taking any political sides or making any judgments on if Trump's decisions are good or bad for the US itself, but rather look at it in the context of where lies the investment opportunities for us in the emerging market universe. So with that being said, Dominic, how do we navigate this challenging or volatile geopolitical landscape, and what keeps us out of the daily noise that comes out of the US?
Yeah, I think we're both looking at the opportunities, but also clearly the risks. I mean, what has happened over the last few weeks has made, I would say, the investment landscape generally more uncertain. Investors like uncertainty. Like certainty. We like being able to do our financial modeling and have a high level of predictability in our numbers. And in certain parts of the world, that has definitely become a little bit more challenging. Maybe just to address the tariff question initially head on, and try and make a little bit of sense of where we think it will have a big impact and where we think that it is not likely to have such a big impact, or not likely to have such a big impact in relation to the other factors that are driving particular economies or particular sectors of the economies. It seems that the intentions of the tariffs are largely to even up trade imbalances, but I think this is also a fairly simplistic way of looking at it, because I think a lot of it is around what is actually constituting those trade imbalances and where these trade imbalances can be leveled up. I understand one of the goals to be taking manufacturing back to the US and the US building or rebuilding their own manufacturing base. Let's take it to the extreme and say they're not going to be rebuilding a textiles business. So from that, we can then follow through into what we're looking at in terms of domestic economies in some of the emerging markets. And despite trade imbalances, we could probably say that textiles is not going to be in the firing line, as again, to take a fairly extreme example. It's pretty clear that the main touch point, if we look globally, or the main hotspot is China, for all sorts of reasons. I think it's believed in the US administration that there isn't a level playing field in terms of trade with China, and in terms of investment as well, and the ability to invest. So clearly there are risks there, but I think even if you look at extreme case scenarios in China, there are a lot of parts of the Chinese economy that are much more exposed to Chinese domestic policy than they are to US foreign policy. And again, to take one sector of the economy, consumer spending, there could be some negative impact on consumer spending if tariffs impact, let's say, unemployment or wages in China. But I think that Chinese domestic policy around getting the Chinese consumer to empty their savings accounts of the record levels of consumer saving or household saving in China, and building domestic consumer confidence, will have a far greater impact. Again, even in what we think is the most exposed country in and most in the firing line, the overriding factor really will be what happens with Chinese domestic policy and how they manage to stimulate consumption. If we go on a quick tour of some of the other major markets, it's pretty clear that Korea is a pretty strong ally of the US, and Taiwan is, we think, to some extent protected by the necessity of the goods that it produces and the absence of alternatives. And so outside of that, you really have a few instances in countries like Mexico, for example, where there is some realistic threat of tariffs, but it's not necessarily targeted at trade, and might be trying to implement other strategies or outcomes that the US administration wants. But again, even in the case of Mexico hasn't really developed a strong growth environment for many years. I think there are far more domestic policies that could be rectified in Mexico that would far outweigh even some of the tariff talk that's been talked about recently. So it's not to say that tariffs won't have an impact. It will, just by definition, probably be an inflationary impact to some extent, if it is done to a very large degree. We don't believe that's the intention. Causing inflation is not the intention. So it remains to be seen how long these tariffs remain in place and how much of an inflationary impact there is. I think just to address the other side of that, because we're not just talking about tariffs, but we did say Trump in the title. There are deflationary aspects of what is trying to be achieved at the moment, with again in a very short space of time, varying degrees of success. I mean, it's absolutely clear that if the intention, and I again won't use political speech, but the administration has said it's the intention. If it is the intention to stop the wars in the Middle East and in Eastern Europe, this could be potentially quite significantly deflationary, particularly when you apply that to things like trade routes through the Suez Canal, or the opening up of trade routes through the Suez Canal, or just simply the amount of travel that oil product now has had to do since the start of the Russia-Ukraine invasion. And if you reverse it, you reverse a lot of incremental, if you like, unnecessary cost in the supply chain. So I think there are both sides of the discussion around both tariffs and inflation and conflicts, that it is certainly too early to suggest what the answer will be. I mean, there's a huge number of different factors at play, and it's not just factors, but it's also time frame. But I think what we are trying to separate and how we are trying to navigate when investing in emerging market countries and ultimately in emerging market stocks through this process is to try and find the exposure where we think that domestic policies, domestic stocks, domestic management, domestic sectors are the biggest drivers of the stock returns that we are expecting to achieve, and in as many cases as possible take out the kind of geopolitical or global factor risks. And this has been since we launched the team or started the team in 2009. This has been our kind of way of investing, and our philosophy around investing in emerging markets. It's never been a buy emerging markets, sell emerging markets binary decision for us. It's very much been, how can we reduce the risks of investing in emerging markets, and how can we get away from the asset class discussion towards the opportunity set discussion. Just before we go any deeper, I'll just give one little example from a country perspective of the kind of weighting that you might ascribe to global factors, regional factors, and country factors, and how this can be and how domestic policy decisions and domestic leadership can really change a country that might be in a particular bad region. If you take the example of Greece over the last 5 years, Greece has been part of the European Union in Europe in the midst of first the COVID crisis, and then significant issues with the largest land war in Europe for many years, and all of the inflationary aspects and degrowth aspects around that, has managed to bring its debt to GDP in the last 5 years down from 300% to 150%, and now have the best debt maturity profile of any country in Europe. This is against, as I say, a backdrop of a very weak regional economic situation and inflationary situation, and just goes to show that even despite those factors, and when we're talking about tariffs, I don't think we're talking about things that are more existential or bigger problems than the Russia-Ukraine conflict. Even in that environment, it is possible, with the right domestic policy decisions and the right leadership on a country level, to create a very strong economy in a very weak backdrop, and a transformational economy, not just a strong economy, one that's really transformed. And we can see that when we look at a country and we look at the individual stocks and dispersion between different stocks that are a function of partly quality of the company and partly the environment it's in, but just as importantly, leadership and the local leadership of a company. So we're really trying to take out in the way we're investing the global risks, if you like, and the global noise, and focus on what really we think can make a difference on a country or stock level.
Just before my next question, I'd like to remind everyone on the webinar that and throughout the next 20 minutes, every listener will have the opportunity to write the question in the little box at the bottom of your screen. And that being said, just coming back to, you mentioned the firing, Mexico being in the firing range. There was a very clear exercise that was made when Trump came into office, where investors were looking at which countries had the biggest trade imbalances with the US. Mexico was surely up there, but right after was Vietnam, which is one of our biggest country exposures in a few of our strategies. How did we tackle this? How did we look at it, and where do we stand now?
Well, I think the numbers show that Vietnam, I think, has the 5th largest trade imbalance with the US of any country out there. And again, what it comes down to is leadership and risk mitigation. So what Vietnam did very quickly was understand the new environment, approach the Trump administration, and I think I'm right in saying that the trade deficit is about somewhere between 100 and 120 billion dollars a year, and offer to buy more US LNG, to buy more of their military equipment from the US, and make small steps towards closing that trade balance. So showing goodwill. So I would say there are the two aspects there. One is that Vietnam have understood very well that where they can, they need to even up their trade balance with the US. This probably only makes a 5 to 7% inroad into the actual trade deficit. But the other aspect is that Vietnam is a very low cost, low wage, low manufacturing cost environment. GDP per capita in Vietnam is only about $5,000. So it is unlikely that a lot of the products that are made in Vietnam and exported to the US are the products that the US is thinking about using to invigorate its domestic manufacturing base. So I think you have to take out, as I mentioned at the start, those products and see where the actual trade deficit is. And we can't say for certain whether there will be sanctions against Vietnam or not, but we can see the risk mitigation, and we can do the analysis of our own portfolio, and we can understand that we're predominantly, almost exclusively, in domestic stocks, such as retail stocks and banks. We have one stock, which is a port company, which is exposed to exports, but it's a small position. And so if we look across our Vietnamese portfolio, we see that only probably 1% of revenues of our companies on average are exposed to the export market. And obviously US tariffs would be a tiny fraction of that. So we don't see too much direct exposure. We then look at what is going on domestically in Vietnam. And Vietnam has had a pretty strong last 10 years in terms of GDP growth. I mean, apart from the COVID year, you've pretty much had somewhere between 5 and 7% GDP growth every year for the last 10 years. You had a new administration come in last year who have set out a clear plan and are actually starting to enact that plan to take that growth rate to 10% in the near future. Maybe not next year, maybe it's 8% next year and 10% the year after, and then continue it at 10% for a number of years. So again, we weigh up the fact that yes, you might get some US tariffs that would impact a small part of the Vietnamese economy. We've estimated the maximum negative impact in a very high tariff environment would be something like 0.4% of GDP. But you put that up against the domestic policies that are being enacted, which will probably, on average, over the next 5 to 10 years, as long as the administration lasts, add more like 2 to 3% to GDP, and say, well, net, yes, tariffs would be bad, but it's the far more important driver of what is happening domestically and the impact on the companies that we invest in is the GDP growth and the domestic policies creating that GDP growth. So when you then drill down into a company that we own, let's say it's a retailer in Vietnam, and you put all these new assumptions, your worst case scenario on tariffs and your positive scenario on GDP outlook into your financial model. The secondary impacts, as I said, we're not directly impacted by tariffs, but the secondary impact is 0.4% of GDP. So let's lower our revenue expectation by 0.4%, but we'll increase it by 2% conservatively because of what the new administration are doing and not just saying they do, but actually enacting. We don't see an increase in risk premium for the country. It's very low inflation, very low debt, very low interest rates. So the net impact of the last 6 to 12 weeks, let's say, is that we're increasing our GDP forecasts on one hand and we're lowering it on the other, but net we see stronger revenue growth, which is a multiplier of GDP growth because of the increasing size of the formal retail market, of probably 3 or 4%, but a negative impact of 0.4% due to the worst case tariff scenario. So when we run our models and come up with target prices, we actually see that we own cheaper stocks in Vietnam than we did at the beginning of the Trump administration. Now, that's not to say that there won't be some nervousness and market impact, and I think that is the bit that is very hard to determine. We understand very much in the long term that US dollar earnings or hard currency earnings growth is what is going to drive share prices. In a highly volatile or crisis environment, I don't think we're in a crisis environment, but in a more volatile environment, things tend to correlate. Equity markets tend to correlate more to one than they were before. But the fundamental issues and risks around tariffs, we don't even see having a significant impact on what you would see in the numbers in terms of trade imbalances with the US as being the largest risk country in our sort of portfolio.
We've been having burning questions on India and the difference with China on trade and tariffs. It seems like India was quick at taking the first step and meeting the Trump administration very quickly in the beginning of his second term, and started playing a bit more ball with the US and finding some sort of a compromise. How does that compare to maybe the stance that Trump would have on China? And you mentioned that in China we're looking at the domestic growth drivers outside of of international trade. Are we doing the same in India?
Yeah, I mean, I would say a few things about India that maybe distinguish it from China. First of all, and I use the term loosely, but it is the world's largest democracy. The personal ties between Modi and Trump go back a long way, before his first administration even. There has been, India is in a very different position, I think, to China in terms of its power, its wealth. I'm not saying it's always going to be like this, because if you look at population growth, China's going in one direction and India in the other, and the Indian economy is clearly doing well. But I think that, again, India is far more susceptible to domestic policies than it is to any trade or tariff related policies from the US. First of all, the trade gap is not nearly as big. I think the the products that are being exported from India are in general at the lower cost or lower value added end of the supply chain or sophistication level of those goods. So I think the kind of manufacture, if you base this on the premise that the idea is to level up the playing field in terms of trading and investment and bring manufacturing back to the US, on the whole, it is the kind of manufacturing that is done in China, Korea, and Taiwan that is going to be tried to be taken back to the US. So I don't see that there might be impacts on India, but India maintaining its current policies of trying to reduce subsidies and increase the amount of infrastructure that would enable it to even approach the levels of manufacturing sophistication and volume that China has are far more important than whether there are some tariffs put in place or not. I think those issues can probably be ironed out quite quickly. I think the Indian deregulation and investment in the power sector is going to be the key driver of whether that economy continues to grow over the next 5 years, and not the level of US tariffs.
It's interesting because the theme on Asia really emerged since probably November when he was voted in. But more recently, we started seeing a lot of activity in Europe, where easing of tensions between the US and Russia have somewhat de-risked the East European region. We were already holding stocks in Eastern Europe, which seem to be benefiting a lot from this easing. Maybe you could explain how we originally looked at Eastern Europe and how this potential peace could catalyze further re-ratings.
Yeah, I mean, again, you have to make certain sort of broad brush assumptions, and on the basis of the first 6 or 7 weeks and what they said they were going to do and what they're actually doing, I tend to move towards the side of, we're going to stop the Russia-Ukraine war as kind of being what probably is going to happen. Now, again, it's not a political comment, and I don't think there's a right or a wrong answer as to how it ends. And I think the swing factor between who thinks and who the rest of the world thinks has got a better deal out of it is probably going to come down to what happens internally to Ukraine. But if we assume there is a significant de-risking in the region, we've already seen immediate impacts that will flow through from Western Europe and Germany, for example, that could create the opposite of what has been happening over the last 3 or 4 years. I mean, it's very clear that there has been a big split between a lot of policies, but particularly towards Russia, between Eastern Europe and Western Europe. And there were a lot of differences prior to that in, let's say, monetary and fiscal policy during COVID between East and Western Europe. So what we have now in our universe of in Eastern Europe is some quite stable, relatively and relative to Europe, high growth countries that we think have the ability to, first of all, significantly re-rate, because number one, the risk premiums will come down, but secondly, take advantage of the investment and the amount of money that will need to at some point flow into the region to, whatever word you like to use, stabilize, rebuild, recreate a buffer zone between Russia and the West, which is ultimately going to be the goal. And I think Germany's €1 trillion of spending announcement is very, very positive for a number of countries in the region. I mean, clearly, more money coming out of Germany and other parts of Western Europe will probably follow, will have big positive implications for Eastern Europe. And our job then is to find the companies that can benefit from that. And we've been positioning ourselves over the last few months, I would say, in sort of understanding the new environment, understanding from 2.5 years of actual experience of how the war has impacted various regions, that there is a bigger risk premium being applied to some places than needed to be, and that there are opportunities that are very good opportunities, regardless of the icing on the cake is that the war ends and the money pours in, but that these companies can do very well, even if the current environment persists. And so, if you look at banks in Poland or even countries like Georgia, which we think have been had unfair risk premiums applied to them. Defense companies, obviously, construction companies. If you take Polish construction, it's in very good shape anyway, just with what is happening with Polish economic growth and the infrastructure bill going on there. If you add on significant exposure to the potential for Ukrainian reconstruction and the operational gearing, obviously, in a lot of these companies, you could see some very high returns being generated. Where, as I say, the icing on the cake is Ukraine, but they are they stand on their own merits, just in a Polish, for example, context.
It's that really is the core of how year to date, looking at global markets and the US in particular being down around 5%. These markets have sort of decorrelated from global flows. Where else do you see other pockets of growth which have broadly nothing to do with Trump, tariffs, and that could further benefit from a global de-risking?
Yeah, I think that the global de-risking is maybe a bit of a misnomer, in that global de-risking, reducing inflation, reducing interest rates, etc., will all be good for equity markets, and we benefit at the margin. But what we're trying to achieve is finding these pockets of growth, if you like, where domestic policies are driving growth and driving company earnings, regardless of what's going on geopolitically. Yeah, if the geopolitics was all great and stable and positive, that would be a bonus. But I think, and giving some other examples, the key driver of returns of Saudi companies, and particularly those who are exposed to Vision 2030, is going to be a continuation of Vision 2030 policies and a move towards Vision 2040, which we'll probably be hearing about quite soon. I don't think there's too much geopolitically that can override the kind of growth rates that are being generated by companies in the non-oil sectors in Saudi. And I think you can now, over the course of the last year, 18 months, very much bring UAE into that as well. Countries with a real plan of how they're going to increase both population, increase productivity, increase stock market valuations, all independent of what's going on in the rest of the world. Now, we've already mentioned Eastern Europe, where countries like Poland and Greece and even Kazakhstan are really being driven domestically, and these countries are navigating very well. Every country has to navigate its own geopolitical situation, but where they're really focusing on domestic drivers. I mean, we see the opposite happening in countries in very similar situations, with sometimes much bigger resource bases and much bigger power within regions, going in the opposite direction. Obvious examples like South Africa, which is one of the richest countries in the world in terms of resources and everything else you need to run a country. If you were building a country from scratch, you'd probably end up with something that looked like South Africa. From a resource perspective, a natural resource perspective, agriculture, etc. But bad mismanagement, bad economic policies, social policies have effectively destroyed the country. You saw 15, 20 years ago, Nigeria is the sixth largest energy producer or oil producer in the world, is closer and closer to being a failed state. You see the example of Venezuela, you see the example of Turkey. So there's some bad bits as well, and now kind of we're trying to navigate and say, okay, well, we want to be involved where we can see domestic reform, domestic leadership, a stable environment, and that's the place we think we're going to find companies that can compound their earnings, and that's where we think that these earnings will be mispriced, because the market just hasn't got there yet. I mean, to be a little bit more up to date and to talk about a country that's kind of on the fence right now, but maybe we'll just kind of highlight what we're talking about. You have a country like Argentina, right now, where we know again from a resource base and from a historic perspective, Argentina was one of the wealthiest countries in the world. They've been through some negative leadership experiences, let's say, but they have what we think is potentially a generation-defining leader in Argentina. We are looking to invest at the point where we think this is sustainable. We're actually, one of our team is in Argentina this week because we need to understand how things are changing and what the dynamic of that change is. But we also don't want to be taking binary country or binary political risk. So what we would be ideally looking for is a clear indication that Milei will be supported in the midterm elections to the extent he was in the presidential elections, which, given that his policies will then start, or should then start to work from making the average person feel better off, should give him a clear 6 years, adding on another presidential election win, to really try and, as I say, change the country generationally. Now, once we are confident that that 6-year period, or reasonably confident that 6-year period will be, will be the environment going forward, then we can start to understand how companies can operate in that environment, and we can start to forecast company earnings and company revenues, and start to have some confidence, if you like, at the company level of risk in what we're investing in. So we're really trying to look at stable growth stories that are independent from these global factors, and make sure we invest at the right time, and then also make sure we're not in the wrong place at the wrong time.
You mentioned earlier Vision 2030 in Saudi Arabia, and I think going back to the point of having strategies which are relatively uncorrelated to the global or US markets, from the perspective of a bottom-up investor, could you maybe give us an example of how you've explained that there is a leadership structure that enables us to find some confidence in the market, to dig into the companies to invest in? Maybe if you could give one example to really illustrate how our investment ideas and process funnels through, it would help to understand us in the broader context.
Yeah, I mean, I would say that we've been following the Saudi vision since it was announced in 2015. And so now we've got 10 years experience, if you like, and data points of how they behave in terms of meeting their targets of what their original vision set out to do. And I would say that 70 to 80% of those targets have been exceeded. So we have a pretty strong level of confidence that when the Saudis under the current administration, and I will always use the caveat that we always retain the liquidity in our funds and set capacity limits to enable us to change our mind if we think that the overall thesis is changing. But we now have, just to Saudi Vision 2030, very strong confidence for the next 5 years that things will be followed through. And the talk of Saudi Vision 2040 gives us a 15-year, fairly stable horizon in which to analyze companies. So, yeah, we've had quite a large investment over the last few years in one of the water companies in Saudi, for example. Now, water is not the kind of sector that you would immediately think you go to emerging markets and to provide growth, a strong growth environment. But if you look at what they said in the National Transformation Plan in Saudi Arabia in 2015, one of the goals, and every line of the economy and social structure had a line item in there, was the goal of taking the percentage of households with clean drinking water coming out of the tap from 15% to 85% by 2030. We've invested in one of the water companies that has 53% share of the water market in Saudi, and you can define its and forecast its revenues and its growth very accurately by understanding that the Saudis will keep to the plan, and this is what will happen, and this company has a 53% market share. Now, there's more than one water company, so we then have to take the analysis to the next stage and work out which is the best management, which management understands, not just how to run the business, but also how to create shareholder value, which is obviously very important for us. And we're in an environment also where the Saudi administration understands equity value and the importance of a high equity market. So we have kind of almost the perfect storm of a very predictable long-term revenue growth path with an administration that understands how to revalue effectively over the years that earnings stream, that company earnings stream.
One of the remarks that we often get is that the Saudi market, in terms of equities, is usually correlated to oil prices, because as soon as oil prices go down, there's this perception that the government will be reducing its level of investments in the country. What have we seen so far over the 10 years that we've invested in Saudi?
Well, I think, first of all, it's become pretty clear that the Saudis are prepared to leverage up. There is no slowdown in the vision. So even when we've had periods of weak oil prices, and it's not just prices, it's also production. You know, the Saudi revenue calculation is price times production. And you've obviously seen OPEC cuts. You've seen the willingness of Saudi Arabia to actually build a yield curve and to take on some debt, because they also understand that they have to do this quickly. You know, the rest of the world constantly telling them they don't want to use oil anymore or fossil fuels is a kind of an existential threat, and so they have to follow through on this plan and create a non-oil economy. So, yeah, Saudi break even, I think, is fairly common knowledge on the budget right now is about $95 for oil. They have been increasing debt, but debt to GDP is only 20%, and GDP is growing, and the currency is pegged to the US dollar, so interest rates are pretty low. So we don't see any signs right now that things are slowing down, or any time over the last 10 years that things have slowed down because of the price of oil, and I don't expect that to change. I mean, we're so far from the point at which the Saudis would have to think about their debt levels and their creditworthiness.
On that topic of oil, we've received many questions on how do we expect Trump's position on climate change to impact emerging markets. What broadly do we think about this, given that he's come out of the Paris agreements and that he just wants to drill?
Yeah, I mean, I think it's kind of as simple as that. And when I talked about earlier about the issue with North Asia particularly, and that's the kind of manufacturing that Trump wants to bring back to the US. The flip side of that, and in every discussion, you know, over the last few weeks, there is always a flip side, is that Asia, and particularly places like China and Taiwan, benefit massively from lower energy prices. And I think there's no question. I mean, if you look at the history of energy, there's no question that lower energy prices benefit productivity and they benefit growth. You know, generally the amount of energy you have to put into something to make it is kind of fixed. It's the productivity and the engineering, etc., that where we can make a difference, but we really can't too much on the energy side. So the lower the energy, the better generally. Now, that's obviously not going to be across the board. I mean, if you are an emerging market that hasn't developed your non-oil economy and you rely on energy for your revenues, and you don't have any other sort of bow to your, or string to your bow, then you're going to suffer. So again, we're trying to take those global risks out and say, you know, there's economies that, yeah, South Africa should be a great example. Again, South Africa should benefit in a high oil price environment, and it should have the tools to benefit in a lower oil price environment as well, because it has the energy. It hasn't developed along the productivity curve, and therefore, you know, lower energy prices, lower commodity prices will probably be bad for South Africa. But there's no reason why that should be the case across the board. So I think, you know, overall, I don't doubt his. If he is going to build a manufacturing base in the US, energy prices have to be lower.
Maybe as a last question, I'd like to touch on valuations, and specifically why active management is attractive for emerging markets. We've seen since the beginning of the year sort of rotation into global value regions. It was Europe and also emerging markets right now. We're getting some comments about EPS growth revisions lower in Saudi Arabia, for example. What do we see in terms of the passive ETFs that investors could invest in versus an active strategy like ours?
I think this is a longer term discussion, if you like. That my view always has been, and it has to be done right in emerging markets. You either have to be passive is one argument, if you like, because there is still quite a strong link between the level of the dollar and the performance of emerging market equity markets. But my view is you take the asset class discussion out by saying, forget that these are emerging markets, these are just markets. And there are certain markets you want to be in, and within those markets, certain stocks. And there are certain markets and stocks that you don't want to be in. And we need to, I mean, our philosophy very much is going back to the original reason why people invested in emerging markets, finance the South American railroads or whatever other historical emerging markets there were. It was how can you find a higher return than you can find in your home market? And I don't think you do that based on an index that is largely constructed from or determined by how much privatization countries have done over the last 30 years through the stock market. I think that we maintain very much that our focus is on where can we find growth and where can we find mispriced growth. I think the other aspect is that we're clearly going to see more dispersion. If globalization moves towards less dispersion, then deglobalization and tariffs and balancing up trade, which will inevitably disrupt some supply chains and cause some kind of deglobalization. I mean, that is the goal of the US. That is going to increase dispersion. And so I think you have to be even more particular about where you are prepared to risk, if you like, and where you actually think you can find higher returns than you can in your home market.
Great. Well, we have stopped receiving questions. Thank you very much, everyone, for attending this webinar. A replay should be on our website very shortly. And if you have any further questions to ask either myself or Dominic, please don't hesitate to email us directly, and we'll make sure to answer promptly. Thank you, everyone, and hopefully see you soon.
Thank you, everyone.